Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a compensating balance loan. In other words, a loan that has a compensating balance requirement, thinking about the interest rate as well as the effective interest rate related to such a loan. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. I'm going to put that into the blue area into the worksheet on the right-hand side. Notice that we do have 2 tabs down below. If you're working in an Excel worksheet that we have provided, you might have 4 tabs, 2 tabs with the answer to it, 2 tabs with the practice worksheets. If we go to the second tab, the second practice worksheet, we see a similar problem with different numbers to it. Back to the first tab. We're going to be working through both of those tabs as we go. The general scenario we have here is we got a company that needs a loan, so they're looking for a loan from the bank. They want to have money that they can actually use, $310,000 for a particular project. And when they go to the bank, they have an option of picking up a loan, but the bank wants a compensating balance, which is basically going to say the bank's going to want some more security on the loan. So note that if you're picking up a loan and the bank sees more risk in it, then what they might do is obviously increase the interest rate, or they might tack on fees or whatnot, or they can do this compensating balance, which is basically saying, hey, I want you to have a minimum requirement in relation to the loan, basically in an account. So it's going to be, in other words, some portion of the loan that you can't use. So in that case, we have to think about, okay, if I'm going to get a loan like that, then how can I compare it with basically other loans? Another kind of strategy that the bank could use instead of using an increased interest rate straight out or having some kind of fees involved in it. You can use this kind of minimum balance. And once again, we get to this problem. Well, how would I compare that maybe to other types of loans? And we can use kind of like the effective interest rate for that type of calculation. So let's imagine this situation. We got the funds needed to borrow, meaning we have a company that wants to use actually $310,000. So, and the interest rate that's being offered is 12%. There's a compensating balance of 20%, meaning that whatever loan that is taken out, the company will then have to take, 20% of it and basically not use it, right? It's going to have to be sitting in the account as a security for the loan itself. So then we're going to think about what the effective interest rate is. So you can't simply just take the 310,000 because we want to actually use 310,000, right? So what we need to do is figure out how much we're going to take out so that the 20% will leave us with 310,000 that we can actually use. First, let's calculate the effective interest rate, and we'll do this kind of more of like an abstract type of calculation, and then we'll use the actual loan itself to basically calculate it again. So let's think about this. We're going to say the effective interest rate we can calculate in this format. We're going to start with the interest rate. So the stated interest rate is going to be the 12% here that was given to us. So that's going to be the interest rate. I'm going to go to the home tab, the numbers group, and the percent. And then we're going to take, this is going to be a subtotal, 1 less the compensating balance. Let's balance percent. Let's say here percent, and then colon. So I'm going to take 1, and I'm not going to put any title there. I'm just going to call it 1, and then I'm going to say the compensating balance percent is going to be this 20%. So we're going to take 1 minus the 20%. Let's percentify this tab, home tab, number group, percentify it. Then we're going to go to the home tab, font group, and underline it, and that's going to give us our 1 less, and then I'm just going to click in here, and I'm going to get rid of the colon, and we'll subtract this out. So this is going to be equal to 1 minus the 20%, which is going to leave us with 80%. Let's go ahead and percentify this. Home tab, number group, percentify. Let's put an underline there. Home tab, font group, and underline. So that's going to give us our effective rate. Let's do some indenting. I'm going to select these two because there's a colon here. Home tab, alignment, indent, and then I'll indent this one more time. Home tab, alignment, indent. And then let's call this, this will be the effective interest rate. So the effective interest rate then is going to be the 12 divided by the 80%. And let's percentify this, going to the home tab, number group, and percentify it. 15, we can add some decimals just to double check. And so we're at the 15. Now, that's a little bit of an abstract way to get to it. we'll make it a little bit more concrete with our loan example. To do that though, first we want to, and so we'll figure out what the actual loan will be, and then we'll use that to calculate the effective rate again on that actual loan balance, and we'll get back to the 15% here. That's a rat. Let's make it a rate. So now let's think about how much we would need. Now, if we want to actually use $310,000, we're going to say, well, that's great, but I need actually $10,000 that I could spend and not just keep into an account. So how much do I have to borrow in order to be left with $310,000 I could actually basically use for what I want to use it for? So to do that, the formula is basically going to be the loan, the amount of funds we need, the 310, divided by 1 minus the 20% or the compensating balance rate. So let's put that into a little worksheet here. We're going to say, all right, so basically I have 310, that's what I need, money needed, and we're going to call the money needed here the principal, even though we're going to have to calculate the loan interest on the full loan. So we're going to say the money we need is going to be this 310,000. And then I'm going to say that we're going to take 1 less the compensating balance. 1 less the compensating balance. I'm going to put a colon here, and I'm going to do this in a little subtotal, so that would be 1 minus the compensating balance percent. Let's just say compensating balance percent. And let's say, so I'm going to say compensating balance percent, and that's going to be the 20%. So let's put an underline here and percentify it. Home tab, numbers group, percentifying it. Home tab, fonts group, underline it. And that's going to give us our 1 less the compensating balance percent. So we're going to say, I'm going to indent these. I'm going to select these 3. Home tab, alignment, increase the indenting here. Home tab, alignment, increase the indenting. We'll then do the division problem or the subtraction problem. This equals 1 or 100% minus the 0.2 or 20%. Let's percentify this. Go into the home tab, numbers, percentify, 80%. Home tab, fonts group, underline. And now we can basically figure how much the loan, how much, let's say, needed to borrow. That's what we called it. And this is going to be the 310 divided by the 80. 310 divided by the 80 is going to give us the 387. The 387. So if you think about that, what we could say is, and let's double check that. We could say, okay, if I took a loan out for 387.5 and then they took out 20% that I got to basically hold in an account and I can't really use it for the thing I want to use it for, let's multiply that out. We're going to say if I took a loan out for the 385 times the 20% that they're going to hold on to for security purposes to make sure we can, pay part of it back, kind of like a deposit type of theory. So that would be the 77,500. So that would mean the 387.5 minus that 77.5 would mean we'd get to actually use for what we want to do the 310. So that's going to be our calculation there. So now we're thinking, okay, we wanted to take a loan out for 310, but we got to take a loan out for 387.5 because we're going to have to basically hold on in an account 77.5 of the loan amount, even though we're paying interest on it. So because the bank wants some security on it, and that's the way they're going to pick it up. Therefore, we have to actually take out the loan for the 387.5 to get the 310 we need to spend. Now that we know that, we could say, okay, if we want to do that, then what's the actual, what's going to be the interest on this loan? This is going to be exactly a 1-year loan here, so we'll make it straightforward for the interest calculation. Interest is the principal or loan amount times the rate times time. So the confusing point here is the loan amount here. The loan amount is going to be for the entire loan. Even though we're calling it principal, we're kind of thinking of the principal as the amount we get to use. But we don't get to use the whole thing, but we have to pay interest on the whole thing. So the loan interest, then we're going to say, all right, the interest that we're going to have is going to be the loan amount, which is going to be this whole thing, the 387.5 we're going to have to pick up, and we're going to have to pay interest on it at a rate of the interest rate of the 12%. Let's percentify that. Home tab, numbers group, percentifying it. I'm going to go to the home tab, fonts group, and underline it. This is for 1 year, so we don't have any time, which just be times 1. So we don't have to worry about time because it's a 1-year loan here. And this is going to be the loan interest then, which would be the 387.5 times the 12%. So that would be our interest for a year. Now that we know the interest for a year, we can use that to basically do our effective interest rate type of calculation now, which we already figured this way up top at 15%, but we can kind of figure it down here now that we know what our interest is. Our typical calculation would say, okay, if I took the interest, the cost of the loan is going to be that 46,500. That's how much it's going to cost me to take out this loan. And then I'm going to compare that to the amount of the loan I actually get to use, which I'm going to call the principal part of the loan. So the amount we get to use, which is, we're going to say the principal of the loan. So this is kind of the tricky factor here because we only get to use the 310. So we're going to say the 310, that's what I get to use. And so again, the time factor is 1 year, so we don't have to worry about the time factor here. So we're taking interest divided by the principal now. And now when we're using this principal, this is a tricky kind of term. We're using the amount we get to use instead of the full loan amount, because part of it we don't get to use, times the time, which is just 1. So we don't have to worry about 1. And then we're going to say this is going to be then the effective interest rate, which is going to be equal to the 46.5 divided by the 310. Let's go ahead and percentify this. Home tab, numbers, percentify it. Let's add some decimals just in case. We don't need to, but just in case, I'm going to underline here, home tab, font group, and underline. So basically, bottom line, we're saying, okay, so I can take out, I need the 310,000, and that means that I have to take out a loan for the 387.5 in order to do it. You're telling me it's a 12% interest rate, but you want to keep 20% of that I don't get to use. So it's kind of like I don't get to use that. So what is the cost or the effective interest rate on the amount that I get to use, the amount that I actually want, the 310? Well, I'm paying interest at 12% on the whole loan. That's 46,500. If I compare that to the amount that I get to use, the 310 for the purposes I want to use it for, then I would say that the cost of the loan compared to the principal I'm taking the loan for would be 15%. So that would be 15%, which we actually also calculated up here in this format as well. All right, so let's try this again. Let's do this one again. We're going to say, all right, let's try this scenario again. We're going to say now the funds we want to borrow, we want to pick up $150,000 to use it, to do something with it. The bank says, okay, we'll give you a 17% interest rate, but we think you're a little bit risky here, so we want a compensating balance of the 19%. So we want a compensating balance of the 19%, which means you don't get to use, part of it, even though we're basically going to charge interest on it. This is what they would do, possibly another option instead of like increasing the interest rate or charging fees or something like that. They can use a method such as this. So then our question is, okay, well, what would the effective interest rate be if I was to compare it to other loans? So I can kind of compare the same thing, apples to apples, as they say. And how much would I have to borrow to actually use the 150,000? And what's kind of like the cost of the loan, which again is the effective interest rate, the interest that we would pay on it, and then the effective interest rate. So we'll calculate the effective interest rate first, and then we'll talk about how much loan we would need, and then we'll calculate the actual interest amount, and then we'll calculate the effective interest rate again. So this is going to be a loan for 1 year. So I'm going to say, all right, let's do the effective interest rate first in this kind of more of an abstract type of format, and then we'll make it more concrete. We can calculate it as, we're going to say the interest rate is going to be the 17%. So the 17% on the outside. I'm going to percentify that. We're going to go to the Home tab, Numbers group, percentify it. And then we're going to say that we have 1, this is going to be a subtotal, less the compensating balance percent, and colon. So that's going to be 1. I'm not going to put any name here. It's just 1 minus the compensating balance percent. And that's going to be equal to the 19%. So 1 minus the compensating balance. I'm going to go to the Home tab. Numbers, going to percentify that, and that's going to give us the 1 less, and then I'm just going to remove the colon at the end of this thing. And there it is. I'm going to indent these now. I'm going to go to the Home tab, Alignment, Indent. Let's indent this one again. Home tab, Alignment, Indent. I'm going to underline here, Home tab, Font Group, and underline. I'll subtract these out. This equals 1 minus the 19. Let's percentify this now. Home tab, Numbers, percentify. So we're at 81. So we took 1 minus the 19. And then we're going to say that this is going to be the effective interest rate, which is going to be equal to the 17% divided by the 81%. Let's percentify that. Home tab, Numbers, percentify, add a couple decimals just in case. So there we have it, 20.99. Let's underline here. Home tab, Font Group, underline. So we can say, okay, that's like 20%. We can compare that to other loans, and we can say, well, that's an effective rate like 20%. Let's go ahead and then see how much we would need to borrow in order to get to that 150. So again, question here is like, I need to use 150, and you're telling me I'm going to have 19% of it I don't get to use. So how much do I need to borrow in order to be able to use the 150 that I want, that I need? Okay, so to do that, we're going to say, all right, let's take the money needed, which we're going to call the principal. The money that we're going to need is going to be the 150,000. And then we're going to divide that by 1 minus the compensating balance percent. So I'm going to make a subtotal 1 less the compensating balance percent and colon. And so I'm just going to say 1, and then I'll say the compensating balance percent, which is going to be equal to the 19. Let's go percentify this. Home tab, Numbers, percentify. Home tab, Font, underline. And that's going to give us, once again, our 1 less the compensating balance percent, and get rid of the colon. I'm going to indent these, selecting these 3 items. Home tab, the alignment, increase the indenting, and then this one. Home tab, alignment, increase the indenting. Then we'll subtract this out, 1 minus the 19. Let's percentify this. Go into the Home tab, Numbers, percentify this. We got the 81. Let's underline it. Home tab, Font Group, and underline. So this is how much needed to borrow. So we're going to have to borrow then the 150,000 divided by the 81%. So we're going to have to borrow 185. So we're saying, okay, I need 150,000 for a year, but you're going to say I have to keep like 19 and I can't use it. So that means that if I take the 185 times the 81%, or 1 minus the compensating balance, that gives me the amount that I need to actually borrow so that I can get the 150 I need to use. Let's prove that. I can say, well, if I take the 185 times the 19%, that means I got to put 185 in, like, I can't use that amount. So then I'm going to say the 185 minus the 185 gives me that 150, which I need, which I'm going to actually, I'm going to do stuff with that money. So then we can figure out then the interest rate on it. So now when I figure the interest rate, even though I only get to use the 150, we got to pay interest on the full loan, the 185. So we're going to say, all right, so let's take the loan amount. This is where it gets a little bit confusing, because when you look at this calculation, we got interest equals principal times rate times time. The principal, we're saying this is kind of, it's like, which number do we use here? Well, when you're calculating the interest in this case, you're calculating the interest on the loan amount, which we'll say is different than the principal. We're going to say the loan amount is going to be the whole 185 you got to pay the interest on. And then the rate is the interest rate, which is going to be this 17%. And we'll percentify that, go into the Home tab, Number Group, percentify, then Home tab, Font Group, and underline. And that's going to give us our interest. So the interest then is going to be the 185 times 17%. So now that we know the interest that we're going to pay, and this is an annual loan, so we didn't have to deal with time here because time is just 1. So this is a loan for 1 year. Now that we know the interest, we can then calculate the effective interest rate, the way we have in the past, because now I know a solid dollar amount. I'm not kind of abstractly, picking it up with the percentages up here. that works, but now it's a little bit more concrete. We can say, well, I have the interest, and I'm going to compare that then to interest divided by the principal times time. Time is 1, so I can compare interest to the principal, and I'm comparing it to the amount of money I get to use. You know, even though I had to pay interest here, I'm going to compare it to the amount of money I get to use to think about how it lines up to other possibilities I might have that would be in a more standard format. That's the use of the effective method. So we're going to say, all right, the interest, the cost of the loan is $31,481. And then what did I call it over here? We called it amount we get to use, right? The amount we get, we don't have to just put that into a, you know. So that's going to be not the whole loan amount that we charge the interest on, but only the 150. That's what we're going to like do stuff with. So I'm going to go to the Home tab, Font Group, and Underline, and that's going to then give us our effective interest rate, which is going to be equal to the 31,481 divided by the 150,000. So we got the Home tab, numbers, percentifying it, and then I'll add a couple decimals. So there we have it, 20.99. We calculated it kind of abstractly up here, and then we figured out, well, how much do I need to borrow so I get to use the 150,000? If you're going to take 19% of it and tell me I can't use that amount, how much do I need to borrow? Well, I got to borrow 185 in order to be able to keep the 150,000 that I get to actually do something with. Well, what's going to be the interest on it? Well, it's a 1-year loan, so we're just going to have the 185, the whole loan amount, even though you only get to do stuff with the 150,000 times the rate of the 17% means you're going to have interest after 1 year, since it's a 1-year loan of the 31,481. Well, what's the effective rate on that interest, considering or comparing it to the portion of the loan I get to do stuff with, the 150,000? Well, that would be the interest that you're charging. This is the cost of the loan, 31,481. Compared to basically the amount we get to use, not the full amount of the loan, but rather the 150 after we take out the 19%. And if you divide those out, then you got an effective rate of the 20.99 that you may be able to compare with other types of loans. Anytime the bank throws another, kind of funny loan thing at you, and do some comparisons with it.